Also, okay, fantastic. So welcome everyone. Thank you for attending today's like how to manage downside volatility. It's always great to meet you all, virtually, although we can't do it in person. And today I want to thank, we have a few investment experts who are going to like elaborate on their particular strategy to help us manage downside volatility without giving up on returns. So what I'm going to do is I'm going to start by giving some background of where we are and how do we look at volatility. And then I'm going to pass it to our experts. And we're going to pass it to our experts here to let them explain, take 10 minutes each to explain that particular strategy on how to manage downside risk. All right. So I think a lot of you know who I am, but let me just introduce myself. I'm Bonnie Yam. My main business, like I do 401k, asset management, but a big part of it, I also do financial wellness education. Currently, I'm teaching with SUNY and on their financial wellness program, and I will be doing it again in fall. And if you're interested, let me know. I think you're going to learn quite a lot. And let me introduce today's speakers. Paul Citrella from Janus Henderson, and he's going to introduce the company's like balanced strategies, which is really good downside risk protection. And then Tim Lebetta from CIM Group, they have a very interesting strategy using real estate, so real assets instead of stocks and bonds. And then finally, we're going to close with Michael Capizzi from First Trust. They have a super interesting product. And I'm not going to elaborate too much of it, but if you want to minimize your downside, but you really want as much upside as possible, they have a very, very interesting product. So without further ado, let me just, give you a little update on the market. I was just checking. And today, we had like a nice run, good returns and so forth. But today the Dow dropped 500 points. So, I mean, there's like a lot of volatility. It goes up very quickly. It can also drop very quickly too. So particularly like we have a nice run. Like, I don't know if you know the return from last year. We'll get to that in a little bit. So we have like some pretty good years, and we have a really good year-to-date return too on S&P and Dow Jones and so forth and so forth. So at this point, we should be more cautious if we want to protect our assets. Now, 2020 is not that far away, but do you remember the volatility? So let me kind of remind you, these like huge drops, day-to-day drops, 12%, 13%, on March the 16th, March the 12th, 10%. It's pretty scary, right? Look, the 13 out of the 20 largest point drops happen in 2020. And if you look at the gains too, 12 out of 20 is also 2020. So it means it goes up and it also drops, huge, big time. So just like this is 10 points drop, right? And then the next day it went up 9%. It's pretty scary. This is really like a roller coaster ride. And then this is March 16th, 13%. And then March 24th, it went up 11%. So there's like a lot of volatility. If you look at it point-wise, percentage instead of points. So we still have like, top three, of 20, percentage losses, and then gains too. So the volatility is definitely there. And I still recall vividly, somebody called me and said, Bonnie, I am at the stage that I don't care if I lost the money, I can take it. I just want to sell everything. That same day, the market went up 10%. So I called her and said, do you still want to sell? No, Bonnie, I changed my mind. I am not going to sell. And thank God, because you did that. Look, I just want to remind you, Dow Jones Industrial Index, after all that volatility, up and down, went up 7%. And if you are investing in NASDAQ, all those like technology stocks went up big time. Everybody is like investing in technology. So if you kind of stay put instead of selling in the worst time, you would be able to ride out the volatility. So that's really the message. And now we did so well. I mean, this is year to date, right? And we already got double-digit return for Dow Jones, NASDAQ, S&P 500, all that, so forth, so forth. So what's going to happen the second half? You can expect when you have all this nice return, you can expect more volatility, right? So any bad news, you can expect that there's going to be some market drought. So here are the big question marks. Key factors affecting market returns. Unemployment. So are we going to get back? You know, now there's a new strain. What's going to happen? I see Moderna today. The vaccine, you know, went up 4.5%. So we don't know. So it's just like a lot of uncertainty. What happened to interest rate? Okay, so we're also worried if interest rate, you know, start going up, moving up again. So all these technology high flying stocks is gonna get hit badly because they're more leveraged up. And what about inflation? So if you go visit the grocery stores, you can see that a lot of stuff is like getting more and more expensive. So it's not a little bit more expensive, quite a bit more expensive. So is this going to be ongoing trend or what? So all that's going to impact our market because we have such a nice run up. So beautiful return. What would you do? You would think like, I might as well just pocket my return. I'm not gonna go invest in some high volatility, high risk. I'm happy with my 13% return. So maybe I'll just sell out. So you're gonna see a lot of volatility. In other words, people are already happy with what they have. Why am I taking further risk? So I expect the second half, you're gonna see a lot more volatility. So how do you manage volatility? Number one strategy is stay invested for the long term because we don't know what's going to happen tomorrow. So you have to plan not for 1 day, 2 day, 1 year, 2 years, really 5, 10, maybe even 15 years, because nobody knows what's going to happen tomorrow. And we want to just like, unless we don't really have the crystal ball in our hand. So you can easily make the wrong guess and make the wrong decision. So just to show you, a lot of people, unfortunately, we're human. So we do get affected by our emotions. And when the market is like going high, we get very happy. Oh, I just made some more money. So maybe I have extra money. I'm going to spend more. I'm going to buy more. So a lot of times that people buy high and they sell low, like the other person, like, oh, okay, so I lost 20, 30%. I'm just going to call it quits. I'm going to sell everything and that's it. So that's exactly the wrong thing that you're doing. You're buying at a very high point and you're selling a low point. So you're not going to make money. So you really have to think a little bit long term and not be overly affected by the market. And then here's some more statistics. You know, the volatility. Okay, 5% drop 3 times a year, 10% 1 time a year, 15% 4 times a year, 20% or more 1 every 6 years. So it does happen. History tells us volatility, market declines is part of investing. So unless like you can't take this, then you better, you know, you better really feel kind of like take this as part of life. But if you look at this is going to make you feel better. If you stay invested, like this is like highest possible return 1 year over this history of like 70 years, okay, from 1950 to 2019. The worst performing year is minus 43%. But if you keep holding, if you hold at least for 5 years, okay, the worst return is minus 6%, the highest return is 29, close to 30. And if you hold for 10 years, the worst 10-year return is minus 3, the best 10-year return is 19%. And then if you can hold for 15 years, then it's always going to be positive. Even if you are the most unlucky person buying the wrong time at the lowest market performance when the market really dropped after just when you bought it, you still end up positive. So if you think long, you know, like a much longer term, at least 10-15 years, then you'd be okay. And when you see these numbers, then when you see these huge market drop, then you don't feel so scared and you won't be selling out at the wrong time. And then here, this is just showing you the 10-year rolling average. Goes up, goes down, goes up, goes down, goes up, goes down. And then as of 12/31, 13.24%. This is pretty high. But there are like negatives of 0. There's negatives here. So it goes up and down. So this is what we're riding through. And you probably heard about this, like a lot of people talk about it. Okay, if you miss a 10 best day, you lose 33%, 20 best day, you lose half, da, da, da. So it's another way of looking at it. Do not do market timing. And then another way of looking at it is dollar cost in averaging. So instead of like throwing all the money on this and investing it on one day, just like, you know, do $100 here and there, you know, fixed time, just like your 401k. And every time when you get payroll, then you buy. So the market is high, then you buy less, market is low, you buy more, and then you average out a certain share price. So you don't overexpose yourself on just one day's return. And here's another way of looking at it, diversify. So there are all these like, okay, large cap, small cap, international. So where should I put my money? Because there's always rolling returns. Like you're not going to have like a winner, clear winner every single year. So large cap is minus 37 here, and now it's like, okay, positive 28. And it jumped like second place now. And then first place here. So you never really know. So the best way to do it is, you know, get a diversified strategy. You not only, yes, you diversify on the upside, but you also diversify away from the downside. By taking a diversified approach, at least you won't be selling out at the wrong time, and you give yourself a little bit more protection. Another way of looking at it is put some more money into fixed income. Anytime when there's like a huge market drop, or this in the past incidents, if you invested in fixed income, that can help you negate some of the drops. So not 100% in the equity either. If you do that, then I make sure you stay invested for 10, 15 years. If you can't do that, then you have to allocate some of it into bond in order to, you know, buffer against the downside. See, like, wow, 19% here. Okay, I don't get 10%, but at least I don't lose 20% of my money. I get 1.6%. So it's still positive. So if you don't know, and then you're worried about it and you need your money, one way to do it is like diversify out of equity and have some bonds. And this is also interesting. This is not exactly what about like market timing and all that. Just want to share with you, there's a reason why value is not always defensive. There's always why, you know, value is not doing so well, you know. And if you look at the value stock, you know, the volatility, standard deviation is a measurement of volatility, 12.8, 12.6. Okay, it's higher than S&P 500. So it's a little bit high, not much, but doesn't mean that just because it's cheap that it's less volatile. It's not true. As a matter of fact, from these statistics, it's more volatile. And then downside capture is like how much it will drop when the market drops. It drops more than the market. It's not always true that if you buy some value stock, it's going to drop less. It's just a misconception. So you have to be, when you pick your stock, pick your mutual funds, you got to be a little bit more careful. And this is just the average drawdown, like average drawdown. If S&P 500 is minus 37.3, then the Russell value is a bit more, okay, minus 8.1, large cap value, minus 8.1. So this is just a little bit more information about value investing. There's always a reason why it is trading low. So just a quick review, and I'm going to pass it over to our investment experts. How to manage volatility, stay calm, and have a long-term perspective. Don't invest just for tomorrow. And volatility is a new norm. When you see the 2020 statistics, and then I think, you know, the second half of 2021, we're going to see some more of it too. Maintain a balanced and broadly diversified portfolio. So just unless you can ride out like 10, 15 years, then if you can't do that, you need the money, or you're really worried about the downside, then you move some money to fixed income. That's a good protection when the market drops. And we talked about time diversification already, so I'm not going to repeat. And use high quality bonds to offset equity volatility. And not all sectors are affected the same way. And we saw that this chart. So we don't know. So put a little bit of money everywhere. And value is not always defensive. So I think this is all I have because I want to save time for our investment experts. Do you guys have any questions?
No.
Nope. All right. So, oh, you know what? One more slide. I thought it's good to at least introduce some metrics. How do you look at volatility? One is beta, which is another way of calling it is systematic risk or market risk. So this is something that you cannot diversify. If the whole market drops, you will drop too. It's not company specific or stock specific. Okay, so that's called beta. Another term is called Sharpe ratio, which is risk adjusted return. That means like how much are you paying for the risk that you're taking, and it's measured against risk-free rate. So if I put money in my bank, checking account, so there's no downside risk, how much additional return are you going to give me for the additional risk that I'm taking? Okay. And standard deviation is basically variability on the mean return. So if it's 7%, okay, so that's the average, but it could hit 20% or minus 15, that's a high standard deviation. So what is the variability to get that average return? And then here, this last one I really want to emphasize called downside capture. We talk about market risk, right? So when the market drop, you don't want to drop as much as the market. So you want to protect yourself from the downside. So it's called the downside capture. It's percentage loss endured when the market goes down. I think that's it. All right, so I'm going to pass it to our investment expert. The first person that's going to be that we have for today is Paul Citarella from Janus Henderson, and they have a special strategy balance fund. They have a really good balance fund, which has a pretty good downside capture. So I'm going to pass it over to Paul. I'm going to stop sharing and pass it over to him.
Great. Thank you, Bonnie. Let me just get my screen shared up here. Can everybody see that?
Yeah, I can see it.
Yeah.
Perfect. All right. So that was an awesome intro, Bonnie. I really appreciate that. A lot of what you touched on there kind of goes into what I'd like to talk about today. So the biggest thing that Bonnie mentioned when it comes to managing volatility is obviously staying invested. So as you can look at the markets, back all the way to, maybe the Great Depression, we see that there's ups and downs, obviously, but if you stay invested, the general trend is upwards. But that really applies to equity markets. So, if you stay invested over the long term, you're going to continue to make more money. But if we're planning for retirement, we have money in our 401k plan, we want to take this money and use it at some point. So even if staying invested for the long term is beneficial, if you're a retiree that needs to take this money and the market's down, that's not going to be good for you. So you have to kind of manage risk within your portfolio using what's called asset allocation, which is kind of what Bonnie touched on, talking about diversification, using bonds to kind of minimize volatility and all that. So as you kind of approach retirement, asset allocation changes. So stocks are more risky, but they have more potential for return. So if you're, say, 30 and you're not going to retire for a while, obviously you have more stocks. You have the time to kind of wait out the ups and downs, and you'll get a better return. As you approach retirement, you want a little bit more bond exposure in your portfolio so that you have that damper volatility. And as you're taking money out, you're not messed up by the fact that the market may be down that day when you need to take income to pay your bills or what have you. So that's asset allocation, and there's a lot of ways to achieve that. One of them is by working with a financial professional, someone like Bonnie, who could tell you, what might be the best mix of stocks and bonds based on your risk tolerance, your age, when you want to retire, things like that. One of the most common ways that people get asset allocation within retirement accounts is through, say, like a target date fund. So you can, pick, say, I'm going to retire in 2050, and then you have a target date fund, which kind of changes asset allocation over time. And that's a great way to do it. So whether it's working with a professional, doing it more passively with a target date fund in a 401k, all of that's great. But what I'm here to talk about today is something we like to call dynamic asset allocation. So the first two options I mentioned, while they are important, they focused on the investor. So whether it's their age or when they're going to retire, that's what's deciding what the asset allocation is. When it comes to dynamic asset allocation from our balanced fund, it's really looking at the market and deciding on what that asset allocation looks like on a day-to-day, week-to-week, year-to-year basis. So I think a great way to look at it is the market really doesn't care when you want to retire, when, like how old you are, things like that. So if you have another component of your portfolio where we have our experts kind of keeping an eye on the market and deciding, what your exposure to stocks and bonds might be beneficial at that time based on some of the economic factors Bonnie mentioned, like interest rates, inflation, unemployment, it can really help you to increase returns and dampen volatility. So that's why our balance fund is our flagship product, where Janus Henderson is about a $400 billion asset manager, and the balance fund actually makes up more than 10% of that. And there's a reason behind that, because this strategy has done extremely well over the last 25 years. When it was incepted, it was actually incepted in 1992, and we'll be turning 30 next year. So this is our team here. We're an active management shop, which means that, if you say you own the SPY index in your 401k, that's just the whole market. We're kind of a different type of asset manager. We're going to be owning just particular stocks that we handpick based on fundamental research and what our experts think will be the best choices for our clients. So this is our team here. Not too much to go over. Let's get into the nitty gritty here. So what is the benefit of dynamic asset allocation? Well, in this chart, which goes back to 1998, you can kind of see in the orange, which is our balance fund equity allocation, which means how much stock exposure we have in our portfolio. And then it's kind of compared to the volatility index, which is that black line. And as you can see, as the black line or the volatility index goes up, our equity allocation goes down. And you can see this happening kind of at different periods of stress in the market. So right before the tech bubble, you see equity volatility kind of going up and our equity exposure going down. Similar thing happening in 2008 here, as well as the highest spike in volatility, like Bonnie was saying, when the market was up and down 10% last year. We have a big spike in volatility here and our equity allocation going down. So what does this do in terms of your return profile and what your risk profile looks like in your account? So you might have heard before, we were talking about if you just stay invested, obviously you're going to have good returns because the market will go up and down, but it generally trends upward. So if you just stay in, you'll be fine. So maybe why should I even have a portfolio that actively allocates between stocks and bonds? Well, since inception, our portfolio has actually shown the ability to keep track with the S&P 500 index with about 50% of the downside risk. So our average equity allocation is about 60% and the rest is in bonds. But we've shown the ability to really keep pace with the S&P 500. So about a 10% return over the total life of our portfolio. And like I said, Bonnie mentioned downside capture and what that means. We've done it with about 50% of the downside capture of the S&P 500. So when the market is down, we tend to be about down half as much is an easy way to look at it. And you can kind of see that in the chart here. So during the tech bubble, you can see in orange, that's how much our balance fund was down. And then in black, you can kind of see how much the S&P 500 index was down. Same goes for 2008. So here you see, so since from the start of 2000 to the end of 2002, our balance fund was cumulatively down 13%, compared to the S&P 500 index down 37.6%. And then in the Great Recession, 2008, our balance fund was down about 15% compared to the S&P 500 of about 37%. So what that does for you is it really gets you back in the black quicker. So as the market rebounds, you're able to participate in those returns, but you're starting from a higher point. So while we don't necessarily have 100% equity exposure and have 100% up capture of the market, because we're always starting from a point of less of a decline, it's actually easier for the portfolio to keep pace with the market and keep our investors in the black instead of in the red. And I'll close with this, just a real life example of how this benefits someone. And it really becomes the most important when people are in retirement and actively taking money out of the account. So like I was saying at the beginning of my speech here, if the market is down 50% and you're a retiree and you have just money in the stock market, but you still need to pay your bills, if you have to take that money out when the market is down quite a bit, it really hurts your return profile over, a full market cycle. So consider this hypothetical. So if an investor enters retirement in the year 2000, they had invested $1 million in our balance fund and had taken an annual withdrawal of $45,000, increased by 2.5% each year to adjust for inflation. They would have seen that investment end 2020 with a balance of over $800,000 while being able to take cumulative income of over $1.1 million over that period. So if you compare that to the S&P 500, and if you had the exact same conditions where you just held the S&P 500 index, took out that income, you would have run out of money in 2018. So you'd have $0 and you would have taken, I believe, close to $1 million in income. But if you had the balance fund, you would have had nearly $900,000 left over in 2020, and you can continue to draw income from it. So if you're able to dampen that volatility and not take money out of your account when your portfolio is down 30, 40, 50%, if you have something like the balance fund that dampens that volatility, it can be extremely beneficial. So that's my piece, and I'll turn it over back to Bonnie, and I really appreciate your time today, guys.
I think this is fantastic. Can you include that piece that you have on your balance fund? By the way, this is a 5-star balance fund and 10% return. This is like nothing small at all. So so we can forward to everybody who's in today's attendance. All right, great.
Absolutely.
Any questions, everybody? No? Then I'm going to pass it over to Tim. Tim, are you ready? You have to stop sharing so you can share. Sorry. This is a very different strategy. So I'm going to let Tim explain. Hello, can't hear you. No. Matt?
Hey, yeah, not sure what's necessarily going on with Tim's audio there, but yeah, just to kind of take over the conversation here. So CIM Group, giving you guys a little background. We're a private equity real estate firm, been around since 1994. Been a part of over 60 billion in projects, currently manage about 30 billion in assets, and we're fully vertically integrated. So what that means is we do our own ground up construction, development, property management, investments, leasing, everything that's done is done in-house. And primarily we've managed assets for large institutions, large pensions, and then really over the last about 2.5, 3 years, developed a number of strategies, bringing those institutional quality portfolios to the retail investors. So this portfolio.
Matt, can you hear me?
Yes, Tim, do you want to take over from here?
Oh, you're back.
Yeah, please. Sorry about that. Holy cow. I spoke up and then I realized that for whatever reason, my audio wasn't working on my phone. But thank you, Matt. Matt's my associate. And thank you for giving that recap on CIM. I think the point here is that we're very big. We're very experienced and we're a very large real estate investment company. Where we think we can help, or where we strive to help, at least as it relates to this conversation and managing volatility, is solving for income and stability in a really difficult time through real estate and real estate investments. And Matt and I meet with a lot of investors, and many are looking for strategies to supplement income with stability, because it's really challenging if you're looking at traditional income solutions, CDs, corporate bonds, munis. I'm sure you'd agree that you're hard pressed to find anything attractive. Yields are very low, and you're also seeing volatility, in some cases, negative performance in really well-known bond funds that have been around for a long time. And this volatility is most likely not going away. To Bonnie's point, if rates stay low or rates go up, fixed income will most likely be a challenging environment for some time to come. So what do you do? What do you do in this current environment, and you're investing in fixed income or individual bonds, or you're in or nearing retirement, and supplementing income is very important to you? We do have a unique solution available called the CIM Real Assets and Credit Fund. And why we think it's important for this conversation is that it's income focused. It's going to provide a 6% annualized distribution, which is paid monthly. And you can either take the dividend or distribution we pay on a monthly basis, or you can reinvest. And it's really built for a goal to provide great income today, but also to protect and participate as inflation and interest rates increase, as opposed to fixed income that isn't paying well and could become, fairly volatile as rates increase. And I think the other benefit of this fund is you can buy it like a mutual fund. The ticker is IRACX. It's available through Bonnie, through Fidelity's mutual fund platform, as well as Schwab's platform. It's going to price daily, but it's also going to perform very differently than a traditional mutual fund, primarily because the value isn't driven based on the supply and demand of the underlying securities. It's based on appraised values of the underlying investments. The minimum is $2,500, so you can broadly help gain additional diversification and then access to direct real assets and real estate within your portfolio, along with robust income. It provides a nice solution. So this fund is managed by CIM. To Matt's point, we've been around for 27 years. We've been a part of $60 billion in transactions. We have a 1,000-person team, and we focus solely on real estate, infrastructure, real estate lending investments. I'm sure, if you looked at our portfolio of over 860 properties, you know who we are. You've seen our properties. Some of you may have visited our properties. What makes up this portfolio is a combination of real assets, which includes different or direct real estate investments and direct private credit. The real assets piece is investing in direct or co-investing in direct real estate. And it could mean any type of direct real estate, multifamily, industrial, infrastructure projects, or even real estate loans where we're providing private commercial loans to borrowers on commercial properties. Within this strategy as well, we can invest in private credit, which is simply private loans to companies that can't get traditional financing. So think of a company like Dell or Staples or Aramark. So the point here is that we have a lot of flexibility in the strategy and a lot of areas that you can't really get in the broad market to take advantage of, one, our opportunity set and invest where we identify the very best risk-adjusted returns. So we have a lot of flexibility to invest in CIM's very best ideas as it relates to stability and income going forward. Another point or another benefit of this strategy is the timing. We launched this fund April 30th of 2020. So if you can think back to April 30th, that was in the midst of the pandemic. So what we found is a lot of other investors and a lot of different funds were challenged in trying to fix their portfolio, where this fund was in a great position to take advantage of really the dislocations created by the pandemic. So how have we done? I mean, I think this, if you look at the flyer, the fund just got the 1-year number, and the fund's up 9%, which includes a distribution of 6% annualized, paid monthly. And I think maybe more importantly, to kind of Bonnie's point in her presentation, is our risk metrics. So how much risk are we taking to provide these type of returns as measured by standard deviation and Sharpe? And you can see, we've got a standard deviation of 1.9. So what that tells you is how far the returns deviate from the mean. And relative to fixed income, this is very low. You're finding very big bond funds or traditional bond funds that have standard deviations 4-5%. The other metric is Sharpe ratio, and Sharpe is simply expected return divided by standard deviation. So if you have a high return but a very high standard deviation, you're going to have a low Sharpe. You want a high Sharpe, and providing a 6.31% Sharpe ratio with a standard deviation of 1.9 and a 9% return with a 6% yield, we feel like it's a great complement to or a replacement for a traditional fixed income portfolio. So again, it's called the CIM Real Assets and Credit Fund. It's a strategy that's available in Schwab's and Fidelity's mutual fund platform through Bonnie. It really seeks to give you institutional access that I think retail investors previously haven't had access to, with a lot of flexibility, the potential to give you that hedge against inflation and rising rates, with great income at 6% and stability. So I'll leave you on that. If you have any questions, certainly you can ask them, or you can reach out to Bonnie, and we can speak individually.
I just want to mention, like, annual standard deviation for Dow Jones is 12%. Okay. And then anything like a Sharpe ratio, if it's a 2%, is already very good. 6.3 is like extremely high. In fact, I think CIM is pretty lucky, because like what Tim says, that they started this portfolio, right when the pandemic started. So they were able to screen out all the bad performing funds, real estate assets. And then they don't have to suffer as much. So this is a good time for them to actually get started. And then the other thing is that we talk about all the other ones, the mutual funds, whatever, they're all equity. And this is like real estate. So if you're worried about inflation and all that, having some real estate, some real assets to be some type of protection against the inflation. So this is just another strategy. So we need diversification. So I thought this is just an interesting way to look at something a little bit different. So thank you, Tim. So we're going to switch over to Michael, and he has something super interesting. I mean, when I look at it, it's like, I go, wow, wow, wow. So take it away, Michael.
Sure. Yeah. Thank you guys so much. Can you hear me okay, Bonnie?
Yep. I can hear you well.
Awesome. Okay. Wonderful. Well, thank you so much for having me. I'm a member of the business development team at a firm that goes by the name SIBO Vest. I'm speaking on behalf of our partners at First Trust. We manage these portfolios. They're distributed through First Trust, who I'm sure many of you are familiar with. And so what I'm here to talk about today is going to run a little bit counter to some of the discussions we're having already, which is a nice diversification to what you may already be doing in your portfolios. But I think what we're really going to hit upon here are the sensitivities to the retail investor, which is, not only do we want to stay invested with confidence, we want to have peace of mind. And so what do we do to produce peace of mind in our lives? We often go out and we buy insurance, whether it's on our lives or on our cars or on our homes. And what we can do by way of our target outcome, or what may be more commonly referred to as buffer ETFs, is buy insurance for your portfolios. Unlike some of those aforementioned subjects, the utility of your insurance might be pretty low. Inside of the context of the market, the equity markets, we will certainly have times where we see sell-offs and recoveries. And so what these products are going to do is they're going to dampen against those losses, and they're going to allow you to participate in gains. And unlike some other forms of investing, whether it be stock selection or bond selection, that's going to be contractual and forward-looking. And so for those of you that are on the call that perhaps are familiar with annuities or structured products, we see those commercials all the time during, if you're watching golf event on a Sunday, that's what these products are, but they are in a much more liquid vehicle inside of an ETF wrapper. And so we call them target outcome ETFs. Again, they may be referred to as buffer ETFs. And I'm just going to walk through some of the use cases, how they work, what they are, and then answer any questions that you might have. So the first thing, and again, none of my commentary is a means to criticize other methods of investing. It works, right? Diversification is something that I employ in my own portfolios. But one of the things that does happen during more stressful times in the market is when there are dramatic drawdowns and what's referred to as correlations between equities and bonds gets very, very high. There's not a lot of places to hide. So we think about timeframes like 2008. We see a lot of red on our screens, not a lot of places to go, especially on the equity side of our portfolios to mitigate losses. If we go back to last year, we saw this again in Q1 of 2020 and into Q2 of 2020, where the S&P 500 at one point was down 33%. And maybe we tried to hide inside of low volatility stocks. And as Bonnie mentioned, they don't always necessarily play out as you might expect. And that's what played out in Q1 and Q2 of 2020. And so what we want to do is take the guesswork out of low volatility equity investing and take the guesswork out of bond investing. And the other thing is when we talk about how we diversify, one of the challenges that we're seeing, and a lot of advisors are talking to us about this, is the fact that the correlations between equities and bonds are higher and higher as time goes on. The past 20 years, you can note that equities and bonds have actually increased their correlation during that time frame. And so what that means is if we are using diversification, that's great. It oftentimes works for us, but we can add another bit of protection to our portfolios by way of our target outcome ETFs because they are not susceptible to this correlation between equities and bonds. The protection is provided through actual contractual protection, not based on stock selection and not based on bonds. And so with that, I introduced to you what we refer to as a target outcome ETF. What is a target outcome ETF? It is a product inside of an ETF wrapper, which will provide you exposure to underlying investments like the S&P, like the NASDAQ growth, like QQQ, or international equities. And we will seek to provide a predetermined level of protection for a 1-year period and upside participation up to a cap. That cap will pay for our protection. And the great news is that we'll know exactly what our pricing is when we invest in this product. What are some of the other advantages? These products do not come with credit risk. They are perpetual in nature. These ETFs are not going to have a maturity date and then disappear. They will simply reset. They will provide low volatility, which is contractual, not based on sector allocation or based on diversification. Again, we have a targeted outcome. I can show you pricing every single day, updated every 15 minutes, right? And so what does that look like? You can go on to First Trust website and see how any of our target outcome ETFs are priced to perform today on the 8th of July at 10:57 a.m. if we were to purchase, for instance, our June product, which is a 10% buffer on the S&P for the next 1 year. You'll see that if the market's up 5%, you will return at a fee 5.73. If the market's down 10, you will be down 2.62%. So these are very transparent and they're very liquid as well. So you can buy in and out of these as you see fit, like any other ETF. If you see where we are based on the street's projections for the S&P 500 this year, we are roughly, and this was a little bit dated, we are up about, call it 12% on the S&P 500 for the year after today. And notice whether you're bullish, bearish, or neutral, these products are priced to offer you protection from here or provide you participation up to what the street is projecting for the rest of the year. So what's available to you as investors currently? We provide a 10% buffer on the S&P every single month of the year with upside to a cap. For bond replacement or for more conservative investors, we have a 25% buffer on the S&P, which goes from -5 to -30. So if the market's down 30%, we'd be down 5 with upside to a cap. And we also have the opportunity to have 10% protection on EFA, 10% protection on the Qs. And we also have a gold product, if you're concerned with inflation, that'll provide you protection with upside to a cap on gold as well. So all of these products are available to Bonnie on Charles Schwab and on Fidelity. She can use them as you see fit. So if you're interested, certainly bring that to Bonnie's attention and you can loop me in or any of the representatives at First Trust to talk more depth about what's available to you. Most recently, we reset our June product. That's a 10% buffer on S&P for June. It came in with a cap, which ended up being about 11.7%. D June had a cap of about 7.6, and then we had Y June with a cap of about 11, and Q June with a cap of about 12. Now this has changed a little bit since we priced these last month, but there's still some interesting pricing, especially after a sell-off such as what we've seen today. So certainly reach out to me as a resource. I support our First Trust team wholeheartedly here at Cboe Vest, and we're here as an additional resource to you, Bonnie, and all of you as clients. So I want to thank you so much for your time. Certainly open to any questions that you have, but that's a little bit of an overview of our target outcome lineup, and I want to thank you for your time.
The good thing about this is an ETF. They also have other products. So what this really does is that, gives you a downside protection. So if you expect the market to be dropping like 30%, if you buy some of these buffers, so your maximum downside may be just 5%. And you're not giving that much because the upside capture is like, let's say 13%. So if you have 13% return, that's already like pretty good. So it limits like the trade, the return, the boundary maybe from 13.5 to like -5. So you're just getting the middle return, which is for most of us would be fine. So if you want continuous exposure and not to have to worry about, that's another way of investing your money. That's basically it. Yeah.
Absolutely.
So I think that's all we have. Thank you, everybody. And I'm going to be like, since this is going to be taped, this is already taped. So I'm going to send everybody the PowerPoint and the recording. And if you have any other questions, so, you can like always like email me and I can help you forward to the speakers. I think the First Trust is a little complex. So if you want to talk more about it, I'm very happy to explain it to you. But I think there are multiple, as you can see, there are multiple ways. If you want simple, there's simple. One way is to just put more money into fixed income or stay invested for the long haul. Or if you don't want to give up some of the upside, then there's some complex strategy like what First Trust is doing, giving you like a buffer so you don't drop so much, so you limit it -10, -5%, but then you have to give up some of your upside. You're not going to get 30%, but you'll be happy with 15. So get the middle range and then stay invested. What we're trying to do is like help you stay invested, not to worry too much about the future, and still get your target return, whatever it is, 7%, 10%, and you would be happy. And then we have some discussion about liquidity, because a lot of us are reaching that age that we want to think about getting money out from our investments. So how do we get reliable income stream? And then particularly when the market is very volatile, we talk about the sequence of return, which is like when you're about to retire, if all of a sudden the market dropped 30%, then you might not have enough money to last that 20, 30 years. So the first couple of years is super important. So, and if you overexpose yourself to a risk, then you might not be able to take the money out, that 4%, whatever, for retirement income. So Janice Henderson has a wonderful piece that talks about how they help you limit the downside, and you can keep drawing that 4% and not have to worry about it because they do active management. So they're going to help you. You don't have to worry about it so long as you invest in it once. They will help you figure it out, and then you can take the money out without having to have to worry too much about the downside. So I'm just trying to summarize. I think this is like, great investment ideas, little bit complex because I don't think we hear it all the time when people talk about this. And then the real estate is always like, interesting. Just have not too much because it can be also volatile. And so, but might be also something that if you want to think about, have like 10%, as like another buffer to help you manage the overall. Sometimes like when the market drops, a lot of sectors drop, maybe real estate is not dropping, just like oil all of a sudden went up 50%. Nobody knows that, right? So it's about diversification and holding on for the long haul and taking, good risks. And that's all I have. So thank you again for attending, and I'll send the recording to everybody. And please do reach out for questions, okay?
Thank you. Have a nice day.
Okay, bye-bye.
Bye.
Thank you. Bye.
Thank you.
Thank you, guys.